Noel Smith from Convex Asset Management talked to us while we were in Chicago at the SIBO. You're based in Vegas, Noel. We got a little rowdy on the mountain, and luckily we found a nice, comfortable space for me to put my busted up leg. You're a savage on the mountain bike, Noel.
That was fun. I mean, I'm glad you're not hurt. I was surprised I got that crash on video.
Yeah, I'm just fake hurt. I'm not real hurt. Tell me about the update from our last conversation. You told us about how you use variance futures because you really like to monitor dispersion in markets, and that's one of your core strategies that you have. What's going on with that? Is anybody catching on to it? Is it still a pretty small market, or how is it working?
It's still pretty small. There's not much liquidity. Variance futures can be used in a dispersion trade as a way, if you have, say you have a short straddle, and that straddle is struck at, 6,500, okay? But as you go away from strike, your options either go to 1 or 0 delta, and you have to restrike it. Or you're doing strangles, same problem. You have to do a strip of options. What variance futures can do for you is take that risk out of the book. So say you're short variance futures in lieu of being short a straddle. You can collect the realized variance as a function of what's happening in the marketplace compared to, say, the options strip or the options straddle or strangle.
Okay.
It allows you to really do the trade a little bit more cleanly, which is one of the reasons that we're looking to do that.
When I think about the who's here, what they're doing, there's a couple big themes. Obviously, Robinhood trading is one of them. And a part of that in the trading world, obviously, Chicago Future of Finance, we're talking options a lot. What's the type of person you think has utility with variance futures? Do you really need to be operating on a very fast kind of institutional basis, or do you think for the everyday person that these tools should be something they start to learn about?
It's absolutely something everybody here, if you're trading options, you should know what variance is, because it's the same thing with the different algebra equation assigned to it. So the idea that you wouldn't understand variance, but you do understand volatility doesn't make any sense.
Yeah.
So it's absolutely something you should think about. So the idea that you can use this product as a way to hedge your book, express anything really, anything you want to do in volatility on an index level. You can't do it for individual names like Google or Apple or whatever. But if you're trading index vol, you should at least know the product exists and how it might also suit your book.
Well, if I take it at its face label, variance futures, and how you use them to hedge volatility, as a poker player in Vegas, who I got wrecked this weekend. These guys are not messing around. But you know what I say, because it's true, it's bad variance. I can't fold kings. I came to Vegas, right? I got pocket kings. What do? The variance is that he had aces, right? Actually, it was she had aces. So if you're a poker player, the mindset, if that's variance, and the professional players will say, I'm down because I'm having bad variance. If you can hedge variance in any way, taking it from the poker analogy, it sounds like a powerful thing.
Well, it's fairly simple. From a hedging standpoint, if you are long variance futures, you will collect the realized variance over the duration of that contract. And you can figure out for yourself, do you want to do that in variance space, or do you want to do that in VIX space with maybe VIX calls? Because a lot of times when people are hedging now, they're using downside puts in SPX, or they're using upside options in VIX. And variance might end up being a preferred product for that, depending on what the market actually gives you.
Tell me about how you're thinking from the advisor side, because that's the other big theme here, is that Robinhood now has millions of clients, and because of the trade PMR deal, there is an advisor side to this story they will see it as a compliment. I think many people will. You've built up this portfolio trading. Now, what do you do with it? How do you think, as an options trader in your own strategies, what fits in that world right now?
Sure. So we've been given an opportunity at the firm level to take some of our IP and our proprietary algorithms and apply them to some of the things that are happening in the RIA space.
Okay.
So what people are doing currently with options is they're selling options as a way to create yield, income, whatever you want to call it. And if we basically apply our IP with some of those strategies, we think we can have a net better product. And what we're looking to do is deploy those ideas and give them to the RIA space so they can have a different, better version, improved version of what's happening right now, which is selling options. We're doing it more opportunistically as opposed to just constantly selling options to the marketplace, kind of naively.
Well, is that the kind of the standard where advisors go, we'll do a call spread, something like that?
Sure.
Is that kind of like
there's nothing wrong with
you
the
want
call
to give them
spread.
something a little bit?
Would you rather sell a call spread when the stock's going up or down? I'd rather sell it when it's going down.
Yeah.
And having some kind of a second level or third level intelligence as to what's going on in the marketplace, as opposed to just blindly selling options into the marketplace, the math supports it's just a clearly superior strategy. There's no reason from a math standpoint you wouldn't want to do that. So if you can put more chips on a better bet and take less chips off, and it's a worse bet. It's very simple.
How much of do you bring the structure to do this over, or do you find that advisors generally have the capacity to go in, have the tools they need to trade options, or have some kind of way to understand, margin, how that changes the risk, how that changes the relationship with their clients? Is it easy to take something and layer it onto that, or do you find the advisor needs to start building that capacity up before they layer in someone who's going to do something like this?
It's going to be more of a case-by-case basis. I don't think there is any one-size-fits-all answer to that question. But I will say, the point of the business is to make it as simple and easy for the advisor. If they can see something like, okay, we're getting 9% to our customers now, can we turn that 9 into a 12 or 13 with a de minimis amount of risk added? I think that's a compelling argument that anybody would want to listen to. And that's exactly what we're trying to achieve.
All right. Noel, great to have you here. Great to see you in Vegas.
Welcome to Vegas.
Thanks for the ride. That was fun.
Of course.
All right. Appreciate the thoughts on the market as always.
Thank